You can sit like in a meeting discussing a case. You can sit and be frustrated that we haven't. Like the end goal is not something that we reach tomorrow.
Right.
And we like set the bar higher and higher, I think, as we go. But at the same time, as you're frustrated about how difficult it is to combine those things, at the same time sometimes you can like cry of joy, because when we make it work, it's just you think to yourself, this is so wild.
Kim, thank you so much for being here with us. It's great to meet you.
Thank you for having me. Excited.
All right, so let's just start the conversation. Tell us a little bit about you, who you are, and what do you do.
So I'm the husband of an ever-embracing wife. I'm the dad of two kids, Eric and Paul, and 4 and 6. And besides that, I also find great excitement in working at ArK Kapital.
Okay, and I think we should just address the elephant in the room. ArK Kapital, what a meteoric rise. We saw recently that you managed to raise 163 million, 165 was it?
Yeah, it's quite a heading, right?
Yeah.
First of all, kudos to the founder team at ArK Kapital, Henrik, Axel, and Oliver. It's such a great job from their side executing on this. Also, I gotta mention, it is a good heading. It's quite a significant amount of debt as well in that rise, even though the equity part of it is quite big as well. But obviously, we need a lot of cash to operate a loan business.
Right, and also in a very short span, right? Because I understand that ArK Kapital was founded just a few months ago.
Oh yeah, so the company was founded like mid-21, but launched 4 or 5 months ago in Sweden and in Denmark, January 1st. So we've been operating like for 4 or 5 months.
Right.
Yeah.
Okay, well, so tell us a little bit about ArK. What's its core value proposition? What do you guys do?
Yeah, so we are an intersection between a loan business and a data business. So at first sight, you would see a loan business where we provide loans for high growth tech companies, startups. Together with that, we also provide data analysis, and it's data analysis that we also use for our loan assessment. So the key thing is that we approach the companies in a way that we believe no one else has done before. We plug in to the raw data, collect the raw data, and use that in our analysis, our assessment. And those analysis we also give back to the companies in a dashboard. So they have access to that 24/7 and have this transparency and see the same. So normally as a lender you would ask for a pitch deck and business plan and the whole financial model. We do that as well. And on top of that, we collect data from the CRM systems. We would like to see how the customers, how they acquire customers, how the customers behave, engage, and how their marketing spend look like. Collecting all that, wrapping it together, and doing analysis on that provides like another picture for us to have comfort in making long-term loans, which is what we do.
Right, and tell us a little bit about AIM. Is that how you call it? Tell us about AIM.
Yeah, so AIM, it stands for ArK Intelligence Machine. AIM provides, collects all the data and provides the analysis that helps us assess the companies and do, you could say, also the risk, the credit scoring. And AIM, you could say, AIM is the part of our loan business that no one else has done before, and no other lender has done before. But also besides that, it makes us capable of doing long-term loans, as I believe only few have done before. The two main things in our value offering is the long-term loans, together with it being a product as you know it actually from the bank. We are not a bank, but it's a product where you only pay interest and fees. You do not pay any equity kickers, no warrants, no exit fees whatsoever. So it's a pure loan product, pure 100% non-dilutive. When we say non-dilutive, we mean non-dilutive. And the aim part of it, the data collecting and analysis part of it, that makes us able to do that.
Right.
Does it make sense?
Yeah, I think it does. So I guess if you're a founder of a startup, you have various different ways of raising money. You can raise through equity, you can raise through debt. Now, why would a founder choose debt over equity? What are the advantages of choosing a debt funding model?
Yeah. Obvious answer would be that, well, it extends your runway until next equity round. It provides, it leverages a higher valuation, so existing owners would feel less diluted. But you can say, besides those obvious reasons, there is also the thing about, one thing could be that often when you have this funding journey, you have different investors around the table with different interests, some with deeper pockets than other. A loan, you could say, is to some distinct, it's like the founders and the early investors ticket to the party, because quite often we would see the early investors and the founders not having the power to follow on in future rounds, equity funding rounds. So having the loan fund, the debt funding as an instrument, it protects their stake in the company, obviously. If you look at it very high level, you would have this typical venture capital funding journey. A company gets founded, it accelerates, its growth rates are 100-200% a year. Investors, VCs flocking to that company to fund it. On the other side, you have companies, obviously a lot more mature, but growing at much lower growth rates, may be capable of obtaining debt through the bank. But the intersection between, or the middle in between those two different scenarios, can sometimes be hard actually to find funding for. So it would be like a company growing 10, 20, 30, 40, 50% a year. A VC, a venture capitalist, might have a hard time seeing a 10x over the next 5 years. The company can't go to the bank because the company is still growing and investing in growth, so burning cash the next year and maybe further out. So a bank wouldn't be able, within the model they are operating, to do loans for a company like that. So who should fund them?
Right.
ArK.
So that's where this whole idea of long-term debt funding comes in, right? It's something that the banks wouldn't even be able to offer in the first place.
I have a background from banking as well. I've been with a large bank for quite some years before joining Danish Vækstfonden and then joining ArK just start of the year. So each time a bank pay out a loan, they have to put aside capital to secure that loan.
Right.
The higher risk they assess, the more capital. And the risk they assess is based on like traditional metrics like solvency ratio, like EBITDA ratio, that you generate a lot of cash in your business to pay back the loan, generate sufficient cash at the time of when the loan is being paid out.
Yes.
What we look at is companies that generate cash far out, down the road.
Right.
So we would have to look at other data, at other metrics than what a bank normally looks at. That's why the exact same company could have a much higher risk score in a bank compared to what when we assess it, because it's other data we look at to assess the risk.
All right, so tell me a bit about the criteria that you take into consideration to assess whether a startup is credit worthy in ArK's perspective.
Yeah, so you could say the most important thing is that we have a case where we burn cash now and the coming year or two maybe. We do that in order to invest in growth. we see it makes sense to do these investments. And if we didn't do these investments and like maybe only grew 5 or 10 or 20% a year instead of the 50% we set out in our base case scenario, quite fast we would turn our cash flow to positive. We would reach cash flow break even, and that's like the main thing in this. We try to find comfort in that the company will reach cash flow break even before they have to start paying back the loan. And in order to do that assessment, and it's here we have the aim and the whole data thing providing us that info. So besides having the base case financial model from the company that you would always ask for as a lender or as an investor, we have this data from AIM that supports all the assumptions in the base case.
Right.
And we would be able to also, in some cases, we can dive into elements in the financial model, question them or saying, well, this could look different or better or worse or whatever, using those analysis from AIM.
Okay, and when you deal with founders, are there any specific skills that you look for in a founder or in the founding team that you then feed into AIM to be able to make a more precise assessment?
Yeah, that would be awesome if we could do that as well, and maybe down the road that's also possible. At this point, it's purely like the hard data collected from the different services they use. So you could say the whole human or people part of assessing a company and the potential in a company, that's still for us frontline people to do those assessments. And I guess that's something you learn through many years, having met hundreds and hundreds of companies and founders and seeing them evolve. Some crash, some succeed. Obviously, there are things when you meet a person and assess a founder or a founder team, there are things that you assess very positive instantly, and then there could be things where you say, well, do we have the complete founder team here, or what do we need more? And then you would have a discussion with the founders around that. We meet a founder team where we say, well, do we need something here, some skill or whatever? Often they would be aware of that already and be ready to have that gap filled down the road, and that's what matters.
Right, then very often we speak to a lot of founders, and we've been able to pick up certain traits, maybe personality traits about how they approach risk, how they approach. It's more of a mindset thing, you know, that that their persistence. Have there been any personality traits that you've picked up from all the founders that you've met that are more indicative of a potential success?
Yeah, good question. Sometimes you meet this person, this founder that just blows you away, and you know within 30 seconds you know this is a founder that is able to take it all the way.
Right.
And what is it that makes you think that? One thing is that obviously you've done your research prior to meeting the person. If the person has had companies, ventures prior to the one we look at now, that's always a good thing. If it was done with success, very good. It could be very good also if it wasn't successful, if you gained experiences that you can bring along in future ventures. But it's proven that when you've tried it before, you have larger probability of success of doing trying to build a company from scratch again.
Right.
And then the other thing, you know, when you meet these persons that they have like this huge charisma, they're just so skilled, so solid, and at the same time they're just like humble or very assertive in the way they communicate with everyone. Obviously they are the ones that builds the culture in the company, and at the same time very strong in like business development and building a company. Then you have a complete person to be able to build a successful company.
And let me just ask on the back of that, because very often we hear that some investors are unwilling to invest on someone that has not failed before. Is that experience with failure something that also you would consider as a key experience from founders?
I would say investors especially the early stage investors, look more to the team and to the persons involved than a lender as we do. Obviously, the persons and the team, it's very important, but we have a larger balance towards the numbers and the thing we can measure, like a more generic approach.
All right. Now, I wanted to ask, because you are a startup yourself. Does the fact that you're in this startup journey also give you a better understanding of what other startups might be going through when you make a decision whether they're good candidates for debt funding?
I would believe so. We feel the same challenges, the same pains in our own body all the way through. So I guess being on the same journey ourselves provides us a perspective that's some others do not have. Sometimes it can be easier to relate to what's going on in the daily life in a startup and what challenges they meet. One thing could, for example, be the whole funding part, how to raise equity. We are on that journey ourselves, doing the mistakes and also succeeding. So I guess trying it out yourself as you go provides you an up-to-date picture of the daily life, of what the daily life is like in a startup, for sure.
Right. Now, you fund mostly tech startups.
Yeah.
Right. Are you able to pick up any trends from fintech startups that are seeking out for funding in terms of the type of innovations that they're bringing to market, or the concepts that are starting that you hear more and more often when they approach you?
Yeah. So yeah, obviously we meet startups across a broad range of industries. Also some fintechs. What I've come across several times now is like the whole embedded thing in different shapes, both in finance but also in insurtech, and I guess it goes under the heading fintech as well. Yeah. But I think it's all about how tech enables us to talk together very smoothly across different platform systems and people. So the whole thing about building a tech stack from scratch, you're able to do that very, very fast today. Doing it modular with APIs brings you in a position where you can, in a very short period of time, build something that provides huge value to very big corporate companies out there who might have a harder time doing that innovation themselves in the company. So that's, I guess that's one thing I see, that within fintech we have some companies very innovative, doing like niche or like very narrow product development for larger financial institutions. And the whole API thing enables companies to do that.
Right. Yeah, we hear embedded finance basically everywhere we turn to these days. So I think there is definitely something boiling in the market, and there's a lot of expectation from that type of innovation. So we're also very, very excited to see what it will deliver.
Yeah.
Let me just ask you one last question. What can we expect from ArK in the next 2 to 3 years?
We launched in Sweden 5 months ago, launched in Denmark 3 months ago. The plan is to roll out across Europe in the coming years. We haven't decided exactly how and when, but I would believe that we will be in one more country within the next year or so. Right now, focus is on doing a lot of loans in Sweden and Denmark and helping with data analysis for those companies, and help companies that might have had a hard time raising equity or debt before, help them in their growth journey.
Right. Well, Kim, that's an amazing innovation in debt funding, and we're very excited to see what comes next for you guys, and thanks very much for being with us.
Thank you very much.